3 non-tech closed-end funds to buy now. Welcome back to Dividend Stockpile, where we talk about all things dividend related. As we have all witnessed, technology-related stocks and funds have dominated the market over the past 10 years. This run has created immense wealth for many investors. But recently, we are seeing a weakness in the tech sector. So I wanted to showcase 3 non-tech related closed-end funds to buy today to diversify away from tech and potentially catch the wave of rotation into other sectors that will likely come over the next few years. So let's get started. As mentioned, tech has dominated. Looking over the last 10 years, the tech sector, as represented by XLK, has delivered almost 19.5% annualized total returns, compared to 7.86% for real estate, 9.37% for utilities, and 9.1% for consumer staples. Additionally, the best performing closed-end funds over that same time frame were all tech related. Check out my recent video of the top 10 best performing closed-end funds popping up on the screen here and at the end of the video to see what the top 10 have been. That said, there has been a shift in recent months away from tech and rotating into other asset classes and sectors. For example, over the past 2 months, the tech sector is down almost 10%, where consumer staples is up over 8% over that same time period. That is quite the divergence. While no one knows for sure which way the market will continue to go, a smart strategy is to diversify your portfolio and your income sources throughout different sectors. So today I'll be discussing 3 closed-end funds that I like that are not tech-focused for your consideration. Remember, I'm not a financial advisor. This is not financial advice. I'm just some guy on the internet. But hopefully this gives you some ideas to add to your watch list or your portfolio. Up first is a dividend company-focused closed-end fund called BDJ, the BlackRock Enhanced Dividend Achievers Closed-End Fund. The fund's primary objective is to provide current income and current gains with a secondary investment objective of long-term capital appreciation. It seeks to achieve this objective by investing in common stocks that pay dividends and have potential for capital appreciation. And they also utilize an option writing strategy to enhance the distributions. BDJ has been around since August of 2005. It pays a monthly distribution at 0.0562 cents per share, giving a current yield of approximately 7.93%. The total returns of this fund over the last 10 years is a solid 8.47% annualized. The top 10 holdings as of today include names such as Wells Fargo, Citigroup, First Citizens Bank, CVS Health, AIG, and Shell. The gross expense ratio is 0.86%, which is reasonable for a closed-end fund, and the fund currently trades at a discount to the net asset value at negative 9.28%, compared to the historical 1 year at negative 10.82%, 3 year at negative 5.5%, and the 5 year at negative 6.28%. Buying closed-end funds at the right time will enhance your returns. For more info on how to look at closed-end funds, including discounts and premiums, please check out the video popping up on the screen right now. And if you're liking this content, it would mean the world to me for you to like the video, subscribe if you haven't, leave a comment on what closed-end funds you like today. I really appreciate it. Okay, on to the second closed-end funds to consider today. Next up is the UTG, the Reeves Utility Income Closed-End Fund. The fund's investment objective is to provide a high level of after-tax income and total return consisting primarily of tax-advantaged dividend income and capital appreciation. The objective is to invest up to 80% of total assets in dividend-paying common and preferred stocks of companies within the utility industry. UTG has been around since February of 2004. It pays monthly at 19 cents per share, giving a current yield of approximately 7.61%. The total returns of this fund over the last 10 years is a solid 7.29%, and the top 10 holdings as of today include such names as Talon Energy, Constellation Energy, Vistra, Deutsche Telekom, and Centerpoint Energy. While the fund is called Utility Fund, the exposure is broader than that. They include utilities, communication services, industrials, energy, real estate, materials, and cash. So this gives you more diversification away from those tech-related names that we discussed at the beginning of the video. The gross expense ratio of this fund is 0.93%, which again is pretty standard for a closed-end fund, but they do use leverage. Currently around 18% of the fund's assets which the interest on that leverage costs around 1.39% a year. So the total expenses for owners is 2.32%. This rate will likely come down as interest rates go down over the next year or so, but it is something to consider. The fund currently trades at a premium to net asset value of 0.44%, compared to a historical 6-month average of 0.93% premium, 1 year at 0.67%, 3 year at 0.60%, and the 5-year normally trades at a premium of 0.99%. Third up is RFI, the Cohen & Steers Total Return Realty Fund. The investment objective of the fund is to achieve a high total return through investment in real estate securities. RFI has been around since September of 1993, pays monthly at 8 cents per share, giving a current yield of approximately 7.22%. The total returns of this fund over 10 years is a solid 9.12%, and the top 10 holdings include such names as American Tower, Welltower, Prologis, Digital Realty Trust, and Simon Property Group. With interest rates expected to decline, real estate should shine as the cost of borrowing goes down. The gross expense ratio of this fund is 0.94%, which again is typical for a closed-end fund, and currently trades at a premium to net asset value of 5.98%, compared to historical 6-month premium of 1.59%, 1 year at 0.80%, and the 3-year premium of 3.03%. As you can see, this fund usually trades at a premium, but given that the tailwinds pushing the real estate sector forward, it may still be a good time to buy for the long run, but there have been better values recently. It is imperative to diversify your investments across different sectors, as we never know which sector will perform best. I recommend keeping each individual holding to 5% or less of your portfolio, and no more than 15% allocated to any one sector, which includes sector-specific closed-end funds like we talked about today, which include BDJ, UTG, and RFI. So thanks for joining today. Check out the next video on the screen here. Remember to subscribe, share with a friend, and keep stockpiling your dividends.